Well guys, the Federal Reserve has finally raised interest rates by 25 basis points, and we have a lot of certainty priced back into the market as we have some clarity on the direction of inflation and the Fed's monetary policy movement. So in this video, I'll be giving you guys a breakdown of the Fed's latest summary of economic projections, give you guys a take on exactly where the stock market is going to potentially bottom in the short term, and at the end I'm going to give you guys the big outlook for me when it comes to my growth stock and small cap investments. But before we get into it guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. And this right here brings us into probably the biggest reason why I think small cap and growth stocks could do relatively well in 2022, and that's because of the effects on bonds with higher interest rates. As we all know, when interest rates go up, that causes bonds to be sold aggressively, and that causes bond yields to start going up. And the simple reason for that is obviously in a bond, you're going to get a fixed return. And if interest rates are certainly higher, then people don't have that much appetite for that fixed return anymore. And so potentially what we could see is when bonds start selling off, people are going to want a return on their money. And since the real estate market is already so expensive and the yield curve is so tight, then the only place people are going to see that return happening is in the stock market. And since the stock market is obviously in a correction right now, people are going to see a lot of deals in these companies, not only in the large caps, but also in the growth and speculative sectors. And so for me, the bullish FOMC sentiment, the good retail sales data that potentially hints at slower inflation, and the fact that bonds are going to start selling off creates a really good scenario for the stock market to continue higher throughout 2022. Now obviously for the S&P 500 specifically, I think we might just see a sideways consolidation because a lot of the valuations for stocks like Apple, Microsoft, and Tesla are still very expensive. But in the smaller cap sector with the IWM and the Russell 2000, there are a lot of deals in this specific sector because obviously for the next 6 months, not only is inflation going to be high, but interest rates are also going to be high, and that's going to create a demand for good returns. And historically, the best returns have always been found in the growth stocks and the small cap stocks, and that is exactly what the Russell 2000 right here shows. The S&P 500 is already trying to break out of this trend line, and although it did close above that today, we still want to see a nice breakout above that 436 level before we see some sort of confirmation of a near-term bottom. We already did put a nice double bottom right here at 415, but now I would like to see a test over this 457 resistance level and a reclaimment of this 50 and 200-day moving averages. Whereas for the IWM, the RSI is going to break that 50 level very soon, and we're also testing that 50-day moving average at the same time. So over the next few weeks, we're definitely going to get an idea for what direction the market's going to potentially pick for the next couple of months. And if we break above this 205 level, then we're going to start seeing a lot of good short squeezes in the stock market. And I think that should definitely play very well for a lot of the growth stock investors. If we look specifically at the heat map, basically every single sector was green apart from consumer defensive, healthcare, real estate, and obviously energy because oil prices are back underneath the $100 a barrel. But obviously, if you look at the 3-month performance, a lot of these stocks in the technology space are still down. So there are still investment opportunities in this market right now. I know it's very difficult to buy when a lot of your stocks are down, but it's safe to say that right now is a very unique investment opportunity because the underlying economy is doing fine. We're just seeing a valuation correction in a lot of the speculative stocks. And this right here is a big reason why I'm personally comfortable buying the dip on my favorite growth stocks, even though a lot of people out there are panic selling and letting go of their very big and high conviction positions. As you can see, margin debt has collapsed significantly since last year, and this actually creates a low risk investment environment, which is exactly the opposite of what many people think when stocks are going down. And as you can see over the long term, when the S&P 500 is in a bull market, margin debt tends to just consolidate sideways. And so the action we're seeing over 2020, 2021, and potentially even 2022 is definitely a signal that the market is in a healthy phase. And so a lot of the arguments about us being in an asset bubble right now are definitely baseless in my opinion. At least for right now, I would definitely not listen to media headlines about what's going on in the market because CNBC, Wall Street Journal, and all of these outlets' job is to basically report to you what's actively going on in the market, not what's going to potentially happen in the future and what's happened in the past. But anyways, if we now move on over to some of the data that came out today, not only did we get the FOMC meeting notes, but we also got the retail sales data that actually came in much better than expected at around 30 basis points instead of the 40 basis points that a lot of analysts had expected. Now, obviously, this does not sound good on the surface, but if you're thinking of this in the form of inflation expectations, this is a really good sign. Because as we all know, this inflation and supply chain problem is all driven by consumer spending, because as we know in the pandemic, people were flush with cash, and they spent a lot of time buying goods online. And obviously, since factories and businesses were shut down, there was a massive supply and demand imbalance that has basically created the modern supply chain problems. And as you can see specifically, we saw a massive decline in online spending, which is a great sign for inflation starting to peak going into the summer. And unless we see a sustained move underneath a negative 1.5% year-over-year decline in retail sales, we're not going to be on track to potentially go into a recession. But what lower consumer spending will definitely hurt is a lot of the consumer discretionary and consumer cyclical stocks, which are stocks like Chewy, Coca-Cola, Ford, Home Depot, and all these other retailers and big box giants. But now with interest rates on the rise, we could see money flow out of these specific companies and into growth stocks. And although the median expectations for real GDP for 2022 actually fell a little bit from the December projections in the FOMC meeting, we're still seeing a healthy number when it comes to unemployment. And unemployment can directly correlate sometimes with inflation, because when unemployment is very high, that could signal to the Fed to be a little bit more accommodative, and as a result, that could increase inflation even more. And if we look at the actual dot plot for the federal funds rate in 2022, on average, the expectations are at around 1.9%. And since obviously this week we raised by around 0.25%, on average, that means we're going to get potentially 7 rate hikes. Now, I don't think the stock market's going to react all that much to that, because we've already known this for the past 5 months. But again, that could signal more catalysts coming for the market. But for me, the most surprising part of the FOMC meeting was not the interest rate hike, it was the inflation expectations by Jerome Powell during the Q&A. Essentially what he said is that he expects inflation to peak in the summer of 2022, and if for some reason it does not, then they're going to be more aggressive with raising rates and potentially do a 50 basis point hike in one of the later fall meetings. But the big thing that Jerome Powell said that really comforted the stock market is the fact that he mentioned the economy can definitely handle tighter monetary policy going forward, and that the Fed's whole motive for price stability is a precursor for a strong labor market. So if the labor market's not strong, then they're not going to go ahead and raise interest rates and start selling bonds. They're going to want to make sure that the economy is very strong before they do this. And so if the underlying economy is strong, that is typically a very good signal for the stock market, because again, the stock market is a reflection of the earnings of a lot of the companies in the economy. And Powell also mentioned that he's not seeing any signs of a wage price spiral yet, which is a great sign for the future of inflation expectations and should be a great signal for the stock market as well. And that is obviously because household and business balance sheets are in the best situation they've been in for the past couple of years, and people are flushed with cash. So even though a lot of businesses might be struggling in the short term because of lower consumer spending, these businesses have a lot of leeway to continue to succeed, and that should obviously be reflected in a healthy stock market. And on the flip side, if mortgage and auto loans go up because of higher interest rates, then that should not be reflected in a sudden collapse of demand from consumers, because they obviously have a lot of cash and margin debt has slowly come down. And so servicing their debt is not going to become that big of an expense either. But anyways guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below your thoughts on what Jerome Powell said, and I'll catch you guys in the next one. Take care.